SoftBank just reported a profit of about $2.2 billion. At first glance, that sounds healthy. But the real story is not the profit. It is how much money SoftBank now needs to keep its AI strategy alive. By October, SoftBank's cumulative investment in OpenAI is expected to reach $64.6 billion, giving it roughly a 13% stake. It has also committed billions to robotics, digital infrastructure, and AI data centers. To fund all of this, SoftBank has sold major investments, borrowed against its shares, arranged a $40 billion bridge loan, and recently secured another $10 billion loan using its OpenAI stake as collateral. This is not a normal technology investment strategy. Masayoshi Son is effectively rebuilding SoftBank around one belief: artificial intelligence will become so economically important that owning the infrastructure, companies, and platforms surrounding it will justify almost any amount of capital invested today. The question is whether he is building one of the most valuable AI portfolios in history, or creating a financial structure that becomes dangerous if AI valuations fall. SoftBank has been here before. During the internet boom, Son became one of the world's richest people as technology valuations exploded. Then the dot-com crash destroyed much of that wealth. Years later, he created the Vision Fund and invested enormous amounts in startups including Uber, WeWork, and dozens of technology companies. Some investments worked. Others became expensive reminders that growth does not automatically create value. Now Son is making an even bigger bet. This time the center of the strategy is OpenAI. SoftBank's investment is expected to total $64.6 billion by October, and Reuters reported that its total investment gain on OpenAI already stands around $45 billion. OpenAI's latest major funding round valued the company at roughly $840 billion, with SoftBank, Amazon, and Nvidia contributing massive amounts of capital. On paper, this looks extraordinary. SoftBank invested early enough that rising OpenAI valuations created tens of billions of dollars in value. But there is a critical difference between owning a profitable public company and owning a stake in a private company. You cannot easily sell it. Imagine owning a house supposedly worth $10 million. Your balance sheet says you are wealthy. But if the house cannot be sold quickly, that valuation does not pay your bills. SoftBank faces a similar problem. Its OpenAI stake may be worth enormous amounts on paper, but the company still needs actual cash to fund new investments and repay debt. That is why financing has become central to the story. SoftBank arranged a $40 billion bridge loan to cover investment commitments during 2026. That loan expires in March 2027, meaning SoftBank will eventually need to repay it, refinance it, or raise cash elsewhere. Then there are margin loans. SoftBank has arranged roughly $20 billion in loans backed by its stake in chip designer Arm and another $7.4 billion backed by shares in its Japanese telecom business. The logic is simple. SoftBank owns valuable assets. Instead of selling them, it uses them as collateral to borrow money. If Arm keeps rising, this can be extremely efficient. SoftBank keeps the shares, gains from future price increases, and receives cash today. But the risk appears when asset prices fall. Suppose SoftBank owns $100 billion of stock and borrows $20 billion against it. Everything looks safe. Now imagine the stock value falls to $50 billion. The loan is still $20 billion. The value supporting that debt just became much smaller. This is why investors watch SoftBank's loan-to-value ratio so closely. SoftBank reported an internal loan-to-value ratio of around 13% at the end of June, well below its self-imposed 25% limit under normal conditions. But S&P calculates leverage differently because it includes certain margin loans, producing a higher figure. That difference matters. SoftBank says its balance sheet has room. Credit analysts see more leverage. Neither calculation is necessarily meaningless. They are measuring risk differently. And now SoftBank has added another layer. It secured a $10 billion loan backed by its OpenAI stake. Earlier attempts had stalled because banks found it difficult to value privately held OpenAI shares. Unlike ARM stock, there is no public market price changing every second. Lenders cannot easily sell the collateral if something goes wrong. SoftBank eventually offered additional repayment guarantees to make the financing more attractive to banks. This reveals something important. SoftBank is no longer simply investing in AI companies. It is using the rising value of those AI investments to finance additional AI investments. OpenAI becomes collateral. The collateral creates cash. The cash funds more AI exposure. If AI valuations continue rising, this cycle becomes incredibly powerful. If they fall, the cycle can work in reverse. That is the hidden leverage inside SoftBank's strategy. And Son is not stopping with OpenAI. In the second half of 2026, SoftBank has committed another $20 billion to OpenAI, approximately $5.4 billion to acquire ABB's robotics business, and around $3.1 billion for infrastructure investor DigitalBridge. These investments reveal the bigger picture. Son does not appear to see AI as one software company. He sees a complete industrial system. OpenAI provides advanced models. ARM provides processor architecture used across billions of devices and increasingly important data center systems. Robotics could give AI a physical body. Digital infrastructure provides data centers and connectivity. Stargate and similar projects provide computing capacity. SoftBank is trying to own pieces across the entire chain. This is very different from buying one successful stock. It is closer to assembling an AI conglomerate. If artificial intelligence becomes embedded in everything from offices and factories to robots and infrastructure, SoftBank could potentially benefit at several stages. But concentration creates risk. The more SoftBank reshapes itself around AI, the less diversified its future becomes. For years, its portfolio contained telecommunications, e-commerce, ride-hailing, fintech, logistics, and many unrelated startups. Now the gravitational center is increasingly clear. AI. Reuters reported that SoftBank sold assets including Nvidia and T-Mobile Holdings as Son redirected capital toward artificial intelligence. That sounds strange. Why would a company bullish on AI sell Nvidia, arguably the most profitable company in the AI boom? Because capital is limited. SoftBank appears to believe it can earn greater strategic value by owning larger positions in OpenAI, ARM, robotics, and infrastructure than by simply holding Nvidia shares. This is classic Masayoshi Son. He does not want exposure to the trend. He wants control over major pieces of it. That creates enormous upside if he is right. It also means there are fewer easy assets left to sell if he needs cash later. Reuters. Breaking Views previously noted that as SoftBank increased its exposure to private AI companies, the proportion of easily liquidated assets in its portfolio declined. That makes headline asset values less comforting because private stakes cannot necessarily be sold quickly at their recorded valuations. This is where OpenAI becomes crucial. If OpenAI eventually goes public at a higher valuation, SoftBank gains several advantages. Its stake becomes easier to value. It becomes easier to borrow against. It becomes easier to sell part of the position. And a successful IPO would validate the enormous paper gains already recorded. If the IPO is delayed or public investors value OpenAI much lower than private investors did, the opposite happens. SoftBank's collateral becomes less powerful. OpenAI therefore matters to SoftBank not only because of future AI profits. It matters to SoftBank's financing system. That is why the relationship between the two companies has become so important. SoftBank is also trying to turn the investment into an operating business rather than remaining only a financial backer. Its Japanese telecom operation has created a joint venture with OpenAI and recently launched an AI-powered cybersecurity service. SoftBank wants to sell OpenAI-based technology to Japanese companies and critical infrastructure operators. That could create an important shift. Instead of earning only when OpenAI's valuation rises, SoftBank can earn revenue by distributing OpenAI technology. This is much healthier strategically. An investment gain exists on paper. A paying enterprise customer produces cash. If SoftBank can become the distribution channel for AI across Japanese corporations, OpenAI may become more than a balance sheet asset. It could become the foundation of a recurring operating business. Still, the latest earnings show how volatile SoftBank remains. Net income fell 18% year-over-year to 347.3 billion yen, around $2.2 billion. But the company also booked approximately 1.86 trillion yen in investment gains during the quarter, with Intel among the biggest contributors. This makes SoftBank different from a normal industrial company. Toyota sells cars. Microsoft sells software and cloud computing. SoftBank's reported profits can move dramatically because the value of companies it owns changes. One quarter may look spectacular because portfolio valuations rise. Another may look weak even when the underlying strategy has barely changed. That makes cash, debt, and asset quality especially important. The key question is not simply, did SoftBank make a profit this quarter? It is, can SoftBank keep funding its commitments without being forced to sell valuable assets at the wrong time? For now, management argues that the AI infrastructure market remains healthy. SoftBank CFO Yoshimitsu Godu said there is clear demand and an overwhelming shortage of supply in AI data centers. If that is correct, SoftBank may be positioning itself before an enormous expansion. AI models need data centers. Data centers need chips. Businesses need AI services. Robots may become another major market. And SoftBank has exposure to each layer. But leverage changes the nature of the bet. Buying an asset with cash means the worst-case scenario is losing the investment. Borrowing against one asset to buy another connects their risks. If ARM falls, borrowing capacity can shrink. If OpenAI's valuation falls, its collateral becomes weaker. If AI infrastructure demand slows, several investments can decline together. SoftBank is therefore not merely betting that AI succeeds. It is betting that many parts of the AI economy remain valuable at the same time. That is much harder. Masayoshi Son has spent decades making concentrated bets that sometimes look irrational before becoming brilliant, and sometimes look brilliant before becoming disasters. His newest strategy may be the largest test yet. SoftBank has turned OpenAI, ARM, debt markets, asset sales, robotics, and infrastructure into one interconnected AI financing machine. If AI becomes the economic platform Son expects, SoftBank could emerge owning critical pieces of the entire system. If the boom cools before those investments begin producing enough cash, investors may discover that the most fragile part of SoftBank's AI empire was never the technology. It was the financing holding everything together.